All right, so welcome to another video. Today what we're going to do is we're going to go ahead and take a look at doing a directional bet on Lowe's with a butterfly spread. So I'm going to show you this concept and idea just because I think it's coming into a nice favorable zone and area. Keep in mind, none of these are recommendations to buy, sell, or trade. I think it's just my own personal opinion. If you want to grab my opinion, check out the Traders Fly website. There's a lot of great stuff over here. Live classes coming up soon. We've got the market seasons class coming up, so you can register for that one. And then we've got a lot of other live classes. You can also ask questions, and definitely check out the Discord channel here as well, where I post some stock movers and charts and many other things as well. And that can be in the link in the description. All right, so let me share with you some thoughts here about Lowe's, and just we'll break down the chart real quick and then show you my thought and process of maybe looking at trading this type of stock. So overall, if we're looking at this stock chart right now, you can see, let's back it up a little bit. We'll go into kind of the past where this stock has been trending higher. We had a little consolidation, trended higher, got to a top area about 260, started to pull back here. We had some resistance around the 240 level, rejected those and coming back into 200. So if you're thinking it might hold the 200 level, this is going to be a nice little cheap shot trade to be able to say, hey, maybe it'll bounce in the next little bit. You do have to keep your eyes peeled for the earnings. So here it says earnings are 518. Double check that because this panel is not always right until we get closer to earnings. But we're looking at about 518 to be earnings. So what I want to do is, as we start looking at the more nearer term, what we're trying to do is put on a butterfly strategy for a possible bounce. And when we do these butterfly strategies, we're just looking for it to touch. We're not trying to get it to expire. We're looking for it to touch. So if I put a butterfly spread around the 210, might I choose 210? Because look, we've already pretty much extended on the downside quite a bit. We've had this wave pattern, kind of like an A to B, B to C, C to D pattern there. 200 also right here is a very psychological mental spot where people get happy and then they'll say, maybe I'll buy some more. Now, again, if the market is a little toppy, if people are unhappy, if we get more selling pressure, obviously the 200 can break through quite a bit. But if you look at the stock's been heading lower, all I'm looking for is a small bounce like any one of these right here, and I'm looking to kind of get out. Okay, so already we've been going down quite a bit. What can't say that I get another bounce right here? So that's what I'm looking for, is just a little bounce or pop. And as I'm looking for this anyway, we can see that here as we're coming down, we're starting to kind of create a round sideways. So again, so this is why I'm looking maybe at a little pop. So how might I construct my butterfly? So I'm looking for 210. I'm looking for it to bounce to 210. Okay, so if I look at Lowe's right here and I pull in Lowe's, and we'll go ahead and pull it up. I definitely want to make sure I don't trade after the 518. So I'm just looking in the longest duration possible. That'll be January, February, March, April, May 15th. So if I do this one, 42 days, the thing with the butterfly spreads is if you go too far duration and it happens, let's say immediately, because we're almost at that price, if it happens immediately, you actually won't profit as well and capitalize, because with the butterflies, you make money, a lot more money when all that premium gets sucked out. It's closer towards expirations really when the butterflies work. So I'm going to choose something maybe about 21, 28 days. That's kind of what I'm really looking for. And if I go 210, here's another thing that I'm watching. Okay, if I go 210, the expected move here is about 12 points, right? So if I'm already at 202, let's say it goes up 12 points. Okay, so that'll put me at 214 points. Now, maybe it doesn't go the full 12, maybe it goes 10, and that's why I say about 210. Okay, I just need it to touch. I could go to the 215 as well. Now what I'm looking for is not the implied volatility, but probability of touching. So as I look into some of these things, the probability of touching these levels, you can see is I got about a 50%, 30%, 17%, 10%. So in these types of trades, it doesn't hurt to choose, a little bit of a lower probability of success, because you can lose much more. Let's say it's a 1 to 5. You can lose about 5 times and win 1, and you're still breaking even. So if I do something around 215, I could do that as well. But let's just start with 210, a little bit, more, shall we say, closer to maybe working out a little bit on the trade, about 21 days. And what you'll see with this trade setup here, the way that this butterfly works and the plan that I would set up for something like this is that, okay, let's say I've got this butterfly spread and I'm going to go ahead and do 10 contracts just to make the numbers a little bigger for you. So that way they're not all in decimal points. But if you're just starting out, you could just do just a single one contract. There's nothing wrong with that. So here we'll unlock the price. I'll make sure I am on the first. So there we go. So now what I'm doing is I'm risking about $760. My theta is about 5. Okay. My vega is negative 13. And what I'm doing is positioning myself at the 210 right here. So that way, if this just goes up a little bit, so it just goes up even a handful of points, I'll get into the zone where I'm going to be profitable on the theta, and it's just going to start decaying fairly quickly. So if I just even pop $3 or $4, again, I just need it to pop. I'm not looking to expire. I just need it to pop. And then I get a little bit of theta, I get some of the vega, and I'm already up about $100 on a risk of about $790, right? So that's quite a big return on your investment. And let's say it goes a few days into it, already you're in this range, and then you take the trade off. So you don't have to wait for this to expire. You're not waiting for it to get right in the center. You could also, once it pops a little bit, take off like half of these contracts. That's another approach. So this is the way I would trade it and plan for something like this. The thing with these trades is you do have to set them up to the point where you could lose the full thing or 80% of the premium invested. So if I put on a trade here and I'm trying to make, let's say, $200, well, I need to be comfortable with losing the full here, 780 or so, okay? Now, if it starts pulling back here, could you get out early? Absolutely, you can. But, you know, if it keeps going, you got to let these probabilities kind of work in your favor, because what it could do is it could actually even overshoot. I could go all the way over here to the 216 and I only take $97. I could get it right here and get a really nice return, but it depends on the duration that I have left. I could just hang around right there. And the great thing about this trade is I could actually just hang around, get a little bit of a theta. Okay, so even if I just hang here, I'm going to be fine for about a week or two, about 2 weeks actually, and my theta will still be positive up until that point, and then it'll start turning to negative. So this has this extra thing called a bleed. Okay, so it's bleeding outside the expiration range. And because of that, it allows you to actually still be profitable outside the range. It's like an iron condor. You have to kind of stay in that expiration. Here, you're going to be out of it because there's just so much money baked into these short options, the negative options. So that's what it allows us to get kind of outside that range a bit and still be profitable for a little while. Okay. So here, as we continue to kind of check this out, you could just do simple one contract. Okay. And I'll go back to here, flow. And that way your theta is kind of minor. But look, you're risking, you could take even a cheap shot. You're risking about $80 and you just need it to pop a little bit. And look, you can make about 14 bucks. Doesn't sound like a lot of money, but when you think about percentages, let's say it's about 15%, that's quite a bit, right? And it could happen within just a couple of weeks, and that's a good return on investment. Some people don't do that in a full year, but the problem with these trades is you do have to kind of say, okay, well, you know, if it keeps going against me, now I could lose like $30, $50, $70, but sometimes the returns can actually be much more. So let's say you've got some decay going, and then this thing pops. So now, if you look at it, you can actually be doing $90 on a risk of only maybe 70. So you can actually make up, if you get a one nice win, you can make up quite a lot of the general losses. So that's why I say, like, even if you win 1 out of 5, these can actually be very favorable, because if you lose, and you win, like, you know, 1 out of 5, if you're just losing only about 30 bucks here, you know, you just take it off. It's not working. It's not running. Take it off for a $30 loss, $30 loss, $30 loss. There's 30, 60, 90. You've got pretty much right there. That's a 1 out of 3. So anyway, it just depends on the different ones that you set up, how you set them up. If you go a little more bullish and you want it to pop a little further, you could move this out, and it uses even less capital, but you need a little bit of a bigger move. And the theta decay will start very soon. So this is a cheaper way where I'm risking tiny bit, $41. It's a cheap way to take a shot. You get a little bit of a pop. And this is where the probabilities become very nice. If you're not winning a bunch of them, it's okay, because here, look, even if it pops a little bit, you're making 46 on about 41, and you're almost always doing a 1-to-1. And if you get a full loss, you know, again, it's not going to hurt you or damage you that bad. These are nice little small trades to do when you're first getting started with butterflies. They're cheap, they're cost effective. and you just kind of need it to touch. You don't need it to expire. So that's why a lot of traders like the butterflies. They're a little more tricky sometimes to manage though, but overall they have some good power behind them with the theta. Once you get closer to this short strikes, there's a lot of power to it. So when you're doing these butterflies, make sure you're doing calls when you're doing it on the upside, puts if you're doing it under the price. You could do an iron butterfly as well, but if you're planning to take them to expiration, use either all calls or all puts. It's just easier from a assignment standpoint. So anyways, I hope that helps, gives you a little idea. You could use this concept and little tip amongst many stocks that maybe are oversold, maybe have taken a little bit of a dip. You know, even stuff like Home Depot here, the same thing. If you're thinking it'll hold at 300, you're just not sure when it's going to bounce. I could do the same construction here, even to the 330, 340, 320, and just say, hey, it looks like it's going to bounce. If you don't even know where the stock will bounce, let me just show you construction on Home Depot. So you go ahead and you say, how long do I want to be in this trade? Let's say I want probabilities to work about 20 days or so, 28 days. I can see that this stock's about looking to move about 16 to 18 points within those durations. So what I'll do is, you know, you take 302 plus your 18. So you're looking for about 320 is kind of your core. So you can go in and put that in there. So there's the 18, 320, buy a butterfly, do all calls. And now I've got this set up, unlock the price, and there's my butterfly. I'm risking $49 to allow this thing to kind of get into there, okay? And look, I barely have a negative theta, a tiny bit. If you're worried about the theta, just bring it a little bit closer, an extra 5 points right there. And now I'm risking about $36 or so for this thing to go. Sometimes you will need to widen it on some of the larger ones just to make it even feasible. And that way it just kind of goes in and makes some reasonable theta and kicks in a little quicker. But you are increasing the risk and capital by doing that. So you can see here I'm risking 164, but if it just pops a little bit right here, you know, and you get a little bit of theta decay and a little bit of short vega, on a $164 position, you're up about $30. So that's like what, 20%, 15%, around there. So yeah, so what I wanted to show you here was a nice little cheap, cost-effective strategy when it comes to butterflies. They're great constructions. You can do a lot of them. I want to show you some awesome classes here as well. If you're brand new to the channel, check them out. We've got one starting April 25th and some other live classes that you could take a look at. And don't forget to check out the channel and chat right here, because there's a lot of different stuff here that goes on, and I can answer your questions as well. You can always book a one-on-one coaching session if you like on the Traders Fly website there as well. Anyway, thanks for joining me. Enjoy the rest of the weekend ahead, and I will see you on the next one. Take care.